Mary and John are in need of life and TPD insurance as they have recently set up a SMSF. There are 15 providers and a choice of online brokers, going direct or using an insurance advisor. So let's first look at their super insurance options. Typically, most Australians hold life and TPD insurance via a super fund. It's often provided when the super account is set up under an automatic acceptance level option. Now this insurance is cheap and subsidised. It requires no medical checks and it provides a cover amount based on a person's income and profession. Insurance in super is very affordable and suitable for many Australians. However, the disadvantage for some is that cover is limited to a set amount. It is funded by super contributions 9.5% and is not tax deductible. It requires a medical assessment, approved by the super fund trustee, and a condition of release to be met to receive an insurance payment. And any occupation TPD cover can be held in super, which has tax consequences if claimed, before age 60. It is also a hard definition to claim on. Insurance in SMSF will cost more, as it is structured for each individual and not on a group basis, like retail industry fund super insurance. The cover always requires a medical assessment, which ensures certainty of payment at claim time, although this can be an issue for some people with existing medical conditions. The cover can be funded using personal income, super contributions and pre-tax dollars, and the policies can be structured to pay a benefit outside of super for TPD under an own occupation definition. Most importantly, insurance in an SMSF has less hurdles to get paid. Life and TPD cover is tax deductible to the SMSF, which is an added benefit. Now that John and Mary understand the basics of SMSF and retail industry super insurance, they need to find a suitable provider and a broker to help them. John and Mary search the internet and find online insurance comparison sites who compare different providers and costs. It appears simple to do it online, but are they getting the best cover? Is it structured to suit their needs? John and Mary don't understand what a waiting period is or what indemnity cover is, and the stepped option seems to be so much cheaper than the level premium option. It's a bit too confusing for them. Then John and Mary remember a recent TV ad for direct insurance. They decide to call them. The operator asks them a few questions. How old are you? Do you smoke or drink? What do you do? And what state do you live in? The cover is then issued on the spot. John and Mary hesitate. They tell the direct insurer that they will get back to them. It just seems too easy. John and Mary speak to a family friend who recently obtained insurance. He refers them to My SMSF. My SMSF explains the difference between stepped and level premiums and indemnity and agreed cover. They also show them the benefits of holding level cover over stepped and how any and own occupation TPD can be structured to hold part in super and part outside to avoid tax implications and super conditions of release. My SMSF tells them that they will need to review their insurances as their circumstances change and that they will help John and Mary if they make a claim. John and Mary finally feel comfortable having all the confusing insurance terms explained in detail. Rolling over super to set up a SMSF can cause you to lose valuable cover you might not be able to replace. So it's always prudent to seek advice on these arrangements.